Well, this is awesome that having Sherri here for the first time at Right Choice. We've been doing business for not quite a decade, but we're getting somewhere up there.
It's got to be 6-ish years, I think.
And it's your first time coming here to Right Choice. Gave you a quick tour.
It is.
That's the bullpen. You've seen it before in videos. Does it look like that?
Everything on the opposite side, but it's all there. Got to see Helen out front.
Yes.
Meet Patsy.
I like it. Not all right, Robin yet. None of the crew are here, but it's all good. Me and you rock and roll.
Yeah.
First thing I want to ask you.
Yeah.
You're a mortgage broker, and we've been doing business a long time, and the difference between a mortgage broker for somebody getting a mortgage and working with the bank.
Yeah. So there's not a lot of difference if you're just out for the best rate, get it done, systematic. That's what the banks tend to be really, really good at is bring me your paperwork. This is what you can get. Go get the house.
Right.
For me, there's a little more personal relationship involved for one. I am legally required to look out for my clients. I'm licensed with Ontario. So we have access to bank rates. We have access to monoline lenders, which are essentially the same thing as a bank, but they only do mortgages. They don't do bank accounts, credit cards, loans.
Right.
So I have access to all of those as well as alternative lenders, private lenders, bunch of other products that might be more beneficial or open more doors for borrowers.
Right.
So, I mean, at the end of the day, the bank's going to be able to get you the same mortgage that I can if you've got great credit, no blemishes, have enough down payment, can just make it happen.
What percentage of people are like that, do you think, roughly-ish?
Well, a lot of them are going to the bank, so I can't include them in my math.
Yeah, but
they shouldn't be.
Yeah.
I would say nowadays it's not as big of a percentage as it used to be.
Right.
One of the things, truly just to say it, there's brokers out there, mortgage brokers out there that have given us a bad name, maybe, right?
No
that
doubt.
just
I know.
aren't doing what they need to do to look out for the client, because that is always our number one, or should always be our number one priority. So for us as a whole, I would like to think that more of us are in it to look out for our clients than just to make as much money as possible, but it happens. Part of that has probably, one of the reasons that people think that having a broker is worse than going to a bank. At the end of the day, truly, we are supposed to, and I take it pretty seriously. I look out for my borrower.
Yeah, totally. Yeah, and see, it's always interesting anytime I bring up to somebody when they're starting to look to buy a house, and I'm like, I have a mortgage broker I'd like to connect you with, and it's not always, but people are like, "Oh, a mortgage broker?"
We are.
It's like realtors. We have
bad word.
We're painted, but I don't know if they think because it means they've heard people go to mortgage brokers, and I don't know if they've had a bad experience, or they think it's because people go to mortgage brokers when they're in really bad shape. I don't know what it is, but sometimes people are like, what's this all about?
Well, but I mean, when you are in really bad shape and you want to buy a house, or you can buy a house, a mortgage broker is probably the only option.
Yeah, for sure.
If you're not going to be able to get a mortgage from a bank, then we are the next step.
Yeah.
We should probably just be the only step as far as I'm concerned.
I agree. I mean, and people working at the bank, if they see this or not, for me, I always tell people this when they start looking to buy a house, that for me as a realtor, the most challenging part isn't finding a house. It's not negotiating a price. It's not trying to figure out if this is the right home or not with contractors or a home inspector. It's the financing component.
Totally.
And this is the big reason that we work so much together is because you're great at your job. Because yes, but it's true. And it's because I've had so many bad experiences with so many banks and mortgage brokers before we were working. And it has cost people the opportunity to own a home.
Yeah.
And for me, that's been frustrating before. Not anymore. That hasn't been a problem.
Thank you.
But when we're doing all these things right, and and I still see it and hear about it, because it's the hardest component of it, where somebody, if they're not doing their job well, they can lose the deal.
Yeah. Well, and I mean, I appreciate you guys so much too, because you do understand that sometimes it's just not going to come together. Maybe not right now.
Yeah, totally.
I'm a big fan of always having a solution. There is always a solution. It just might be a little bit further down the road if it's not today. But with all of that, it's one of those things where we can look out for each other together, because if you know that it's not the right time for that borrower, and you're not forcing me to figure out a way to make it the right time for the borrower, and we're just going to work at it, it ends up always looking out for them.
Yeah.
And I mean, my side of the job of the home ownership, it's horrible. Like, I mean, I love my job.
Yeah.
Nobody necessarily loves to have to talk to me about the stuff that they have to do to get the mortgage.
Totally.
The stuff they have to do to get to the point of almost being ready for the mortgage. Like, we talk about budgeting and financial responsibility, and then the paperwork. I'm annoying with paperwork. And then at the end of all of it, I get to tell them that maybe they can't afford the house that they think that they want to buy, or maybe they can, but this is how much it's going to cost every month to make that payment in that house. So like, I am start to finish full of bad news. Even if it's good news,
Your
right?
reality check.
I am reality.
Here is reality.
And it's tough news for some people, like
Totally.
leaving maybe a rental situation where it's affordable, but I mean, when you're renting, you have to worry that somebody's about to sell that house right from under you. And so going from rent where maybe you're paying $1,600 a month, and then having to say, right, but it's going to now be $2,200 or $2,300 plus property taxes and utilities and insurance and maintenance.
And that's scary.
Yeah. And please still be excited about this at the end of the day, because it is also your house, your future, your equity.
Yeah.
But I come full of homework.
Yeah. Lots. Yeah.
Lots of homework.
But I think you touched on one good thing that we work so well together, because like the foundation for me here, and I'm sure you know, but is the people that we work with first. And like now, me as a broker of record, it's the people that work with me. And it's that we are doing everything the best for everybody we're working with. And that's key that you're like that. And that's why for me, it's not frustrating going through the process, because like you said, sometimes the right solution is not buying now. And that's what's right for them.
Yep.
So like, yeah, we're not pushing a sale.
No, you absolutely do recognize the marathon, and that's kind of, there's some people that are ready right out of the gate, and there's others that aren't. And I think that across the board, even the agents that you bring on or train and school through this, they all learn that same
mentality. Yeah.
Yeah. And there's a little more peace involved in, you're not ready just yet, but let's get you ready.
Yeah. Yeah, which is a lot of people. And we didn't quite get into it, but I think it's important. You mentioned it. A mortgage isn't just the interest rate. There's also the penalty.
Yep.
And also prepayment options. These are things that not a lot of people, conversations don't come up with us often.
No.
Because everybody's so fixated on the rate.
Yep.
But those components are important too. Right? Yeah. So
Huge.
like, what can we talk about with like, when I know every case is different, but with those things, what maybe people don't even know the prepayment or penalty, how those things work.
So let's talk about, in my opinion, the next thing that we have to worry about, because right now we're, sort of coming off the heels of COVID, cheap money to borrow, all of that stuff, and now people are having to go back to work. Gas costs a whole bunch of money. Who knows where some people are financially because of inflation and all of that stuff. On the mortgage side of things, or in the real estate market in general, Bank of Canada is popular topic, right?
Very.
Every couple months, every month and a half, we know that there's going to be a new announcement and what's going to happen and what's it going to look like. I think that soon, within the next few months-ish, it's going to probably start shifting from being I'm hoping it starts shifting about being concerned what the Bank of Canada is going to do. I hope that they will continue to pause going forward and not continue to increase the rate.
Yeah.
Fingers crossed.
Yeah.
But what happens when they pause and things start to get better? Because then there's a whole bunch of people that have these high interest rates that are going to want to look at breaking the interest rate and moving on to something else.
Very good point.
So I think, did I call myself a bad news bear? Because I do that at home. That I am full of like all of the things that we have to be worried about.
I think we don't say bad news. I think reality check is way better.
But I put a friendly little spin on it where it's probably not great news, but at least we're aware that it's potentially coming and it's something to look after or be prepared for. So with a prepayment penalty, or prepayment options. Let's talk about prepayment options first.
Yeah.
Any mortgage comes with the opportunity to make lump sum payments towards your principal balance on your mortgage to shorten the life. So,
which equals, sorry to interrupt quickly, less interest paid.
Less interest paid, more principal paid, a lower balance at the end of the term, or when it comes to paying off the mortgage early. So all of the opportunities that you have throughout the life of the mortgage to make prepayments, if you can, add up, even the smallest little bit. And this goes into like the budgeting and financial responsibility that I tend to talk about. As far as a prepayment goes, you are allowed anywhere from 10 to 25% of either lump sum payments per year, 10 to 25% of the mortgage balance, the principal, when you first take it on. You can also increase your monthly or biweekly payment by 15, 20%.
I didn't even know that.
If it was $20 that you paid extra every 2 weeks, it adds up.
And if you did that, would that be towards principal or blended?
It only ever goes towards principal.
Really?
So
I didn't even know this.
Oh, well, there you go.
Look
Depending
at this.
on who your lender
10
is.
minutes in,
learning
love
stuff.
It.
Yeah. So a lot of people, one of the sensible things to do at renewal when rates are going lower, so this is something to be mindful of in the next couple of years as people's mortgage comes up. If they don't have to access any equity or pay off or consolidate any debt, if they're not able to, if I'm not able to find them a better rate somewhere else than what they're getting offered on renewal, because at the end of, let's say, a 5-year term, you're going to get offered another rate to stay with whichever lender you're with, which I would like to touch on that in a second.
Yeah, I like that.
But at that point, if you don't need any new money and the interest rates have gone down, you could take on the lower rate, ask them to set it for the payment that you've been paying, because if you're used to it, if you're used to $1,500 every 2 weeks, and the reduction in the rate maybe makes it $1,375 or something like that, set it to $1,500.
Leave it there.
It's $125 biweekly extra going towards your principal. Yeah,
That's amazing.
and it's one thing, one little tool of something to just be mindful of going forward. If it's doable, only if it's doable. Don't be house poor. If you've been waiting for your rate to come down so that your payment was easier to manage, do that. But if you can, take the increase. And just to go back, the thing I wanted to touch on is when your renewal comes up, don't just ever sign it back. That's kind of the other, when we're going back to me versus a bank.
Right.
I am team Joe or whomever forever. And even if you don't come back to me at renewal, if it makes more sense to stay where you're going to stay, or if we can find you a better rate, it's absolutely worth the conversation. So, by bank standards, by anybody's standards, they usually send you a renewal with a slightly higher interest rate than what they're. It's like a cell phone plan. Do you ever look up new cell phone plans and they're like, new customers can get this, but you're stuck with something higher? And if you just keep renewing and paying or whatever, you're kind of the sucker by not taking advantage of calling customer service and asking for a better payment plan, right?
Interesting. That's good to know.
So rates the same. Even if it's only a quarter point or something like that, there's a couple things we can do. We can look to see if there's something better, or I can tell you what I could get you, and you can have that conversation with your bank if you wanted to. I mean, I don't do that often because that puts me out of business. But I'm looking out for you. So if there is a better rate with the bank, then I want you to do that.
Interesting.
But you should never sign it back. It's worth a phone call, but that's where the benefit from me comes in, because you call your bank advisor and they're not going to necessarily say, well, maybe it's high, maybe not, right? I'm going to say, it's high. It's higher than what we can do. And this is what it's going to cost to get you a new mortgage. And do you want to? Like, let's hurry. Let's get this done. Maybe you want to change the structure of your mortgage. Maybe you want to add a home equity line of credit or something to go along with it because we get to have another conversation about it.
Right.
Or maybe everything's just perfect and we need to switch you to somebody. But these are the options that we have. And it doesn't take a long time.
Yeah.
And it's worth thousands potentially.
Yeah, definitely worth thousands. That's good to know. I did not know that tended to be a thing for renewal, that they would edge it up a little bit, but it makes complete sense.
Yeah. It's easy money for them. And by them, I mean every single lender, every bank, they don't have to go through any process. If you're just signing it back, nobody else is looking at it. There's no extra paperwork.
Yeah.
Other than the retention company or whatever that's going to call you and follow up.
Interesting. That is good to know.
Yeah.
I like that.
Call your broker.
Yeah, totally. I like one. What is the interest rates right now?
Today?
Yeah.
Today is going to probably be different than next week is different than last week. And so
it changes that much.
Yeah. And so right now, and we're going to talk about fixed rates because variables just garbage anyway.
Yeah.
I mean, if anybody is wondering, prime is 7.2% right now, and variables, if you have less than 20% down, is usually prime minus 1.1 ish.
Mm-hmm. Yeah.
Let's say minus 1%.
Yeah.
Or if it's conventional, which we'll touch on and sort of explain in a second as I'm going through this, but conventional would be prime minus 0.4%, minus 0.5%. So somebody would have to really be choosing to take on 6.7% interest.
So hold on, let's even clarify for people that don't understand. Prime means what?
Prime is...
Because that's not the mortgage rate that people are...
No, it's also not the Bank of Canada rate.
Right. So that's the thing that I think
Am I even ready for this? I might have to Google to make sure I don't butcher the definition.
That's okay. Yeah, because that's the thing. There's the Bank of Canada. I think they call it the overnight rate.
Yep.
There's prime. There's mortgage rate. There's variable. Benchmark, stress tests.
Yeah.
Like there's all these different things. I don't know if... So
to not overcomplicate it.
Yeah, maybe we keep it simple.
Most of them don't necessarily matter to anybody other than they're high.
Right.
Okay.
Yes.
So Bank of Canada, the overnight rate, that's the rate that it costs for the banks to borrow money from the government, essentially, or from anybody that's borrowing from the Bank of Canada.
Yeah.
They are getting charged 5% right now.
Yeah.
The overnight rate has a direct correlation to prime, essentially.
Yeah.
If the Bank of Canada rate goes up by 0.25%, so does prime.
Yeah.
Banks, other lenders do also reserve the right to have their own prime because that is their internal gauge for the cost of borrowing. That is what they indirectly sort of do their math based on. If you get a line of credit, unsecured, meaning not against your house, not against some form of chattel or a security. So just a personal line of credit is prime plus 3, 4, or 5%, something like that.
Right.
Fluctuates. If you have a personal credit line, you can go onto your bank account and it'll show you what your math is. Variable is a calculation based on the prime rate of that particular lender. So if somebody decided that they wanted their prime rate to be higher than everybody else's, they could. So it's their prime. So if they wanted to set it to 7.5% and they were prime minus 1%, they're not getting any variable business anyway. But it's their internal gauge. Benchmark has become obsolete for right now. So that was a mortgage rate also set out to help qualify fixed rate mortgages or variable. So the old rule used to be, and by used to, I mean, we've gone through so many policy changes in the last 6 years.
No doubt.
And I'm going back a little bit, but it used to be that if you were to qualify for variable, you only had to qualify at benchmark.
Okay.
And benchmark would also have an indirect adjustment depending on Bank of Canada, depending on prime, but it was a fixed calculation. And again, this is all going into the weeds, things that most people don't necessarily need to be worried about. But it changed. And if we're going to talk about rates, it's good to know. Like it was, so variable, you had to qualify at benchmark, and benchmark right now is at 5.25%.
Okay.
So if before all of these rate hikes, if you were trying to get a variable mortgage, you had to qualify at 5.25 because essentially prime and prime minus whatever to get that variable was less than benchmark. So it was theoretically a stress test already built in.
Right. Interesting.
To make sure that if prime fluctuated, if your variable rate fluctuated, you were already being calculated or qualified at this higher interest rate.
Right.
And so variable, you had to qualify at benchmark. Fixed, you had to qualify at contract.
Okay.
So if contract was, and this is back when contract would be somewhere around 2.8%, variable was better because you end up paying more principal, and if prime goes low or whatever.
Right.
But it was harder to qualify for.
Makes
so
sense.
not everybody qualified for a variable mortgage, even if they heard that variable was the way to go, because it was very popular.
At that point.
Yeah.
Which it's not
very popular right now.
Yeah.
So if you could get away with being qualified at contract at 2.7% versus having to qualify at 5.25%, you get more house at 2.79. So then they started coming out with different adjustments on that. And we now have to qualify at 2% above contract or benchmark, whichever is greater.
Gotcha.
And that is
Stress
for
test.
variable and fixed.
Gotcha.
And they came out with that because, and honestly, I mean, there are mixed reviews about it. Most people hate it.
Yeah. Eh?
I hate it a lot right now.
Yeah. Interesting.
But when it first came out, I mean, there's no crystal ball to predict the economy going into the
but
dumper.
It was an indicator.
But it will, rates being too low for too long was an indicator of potential problems coming up.
Yeah.
Because for anybody that was trying to get into the housing market a couple years ago, you couldn't win a bid easily, right? You couldn't be the winning offer unless you were going way over asking or no conditions or whatever.
Yeah.
In doing all of that, it drove prices up, and it was cheap to borrow, cheap money. Everybody likes cheap money.
Yeah.
And so what the stress test was supposed to do was to save people from themselves, because the number of
it makes sense in theory.
Well, so the thing that I always have to remind myself is that you sometimes can't save everybody from themselves, because we are our number one worst enemy a lot of the times, whether it's wanting that bigger house despite affordability.
Yeah.
If the numbers don't work, if you are functioning at a deficit, meaning less money coming in than money going out, you can't afford that.
Yeah.
But you want it.
Yeah.
Right? The Joneses have it. I'm going to get it.
Yeah.
And you can add a cosigner, you can try to have a bigger down payment or something like that. But at the end of the day, if there's not enough money coming in, it's a problem. So people would sorry, best you can do is 450, 500,000. No. But the house that I want is 6.
Yep.
So options, bigger down payment, cosigner, but we then need to have a conversation about affordability. And, people were doing what they could to buy. So the stress test was supposed to be there to prevent people from over purchasing, because what happens if something goes wrong? You're getting 2.79% now, and this is in 2017, 2018. What happens if you're getting 2.79% today, and in 4 or 5 years, when your mortgage comes up for maturity, because the standard term is a 5-year, so you're guaranteed a rate for 5 years, but you're not guaranteed it indefinitely. And at the end of 5 years, which brings us to 2023 for those 2018 people, they could afford 2.79%. They were qualified at benchmark, not the stress test. And now all of a sudden, they are having to qualify on about 5.89%. So
Yowzer.
3%, sorry, the rate they could get is around 5.89%. They are having to qualify at 7.89% because of the 2% stress test that the government brought in. Like, how do you qualify for the same mortgage? I mean, with hopefully bring in those prepayment conversations, right? So hopefully you've paid a little bit of the mortgage down. Most people don't take advantage of the prepayment option.
Yeah.
If all you needed to do was renew, great, because maybe you can't qualify for something better, because that's one of the conversations, right? You get your renewal in the mail, we have a conversation, we can look at income and qualifying and all that stuff. If you don't qualify, the only option you have is to renew at whatever they offer you.
So, yeah, let me just clarify on that.
Please.
When people sign a mortgage, 25-year term, very common.
25 amortization.
Amortization. Yeah, sorry. But it's common for the 5-year term.
Yeah.
And when that comes up for renewal, like you talked about, first thing is to renegotiate. But do they have to qualify for that mortgage?
They do.
So there is a chance that people will not qualify for their house after owning it for 5 years.
That they can't access new money. That's kind of what it is. Rarely will a bank recall a mortgage and say, I don't care if you can qualify for or I don't care if you want to just renew. We want our money back. Like that doesn't really happen right now on a standard mortgage.
Gotcha.
But yeah, so you get a standard is a 5-year term.
Mm-hmm.
Anything less than 20% down, it has to be a 25-year amortization. The amortization is just the life of the mortgage, but it's really the math. So if your mortgage amount is $400,000 and your interest rate is 5.59%, what is the monthly payment if your mortgage were paid off in 25 years, right? That's how we solve for Y or whatever.
Yeah.
If you have more than 20% down, you can stretch it to a 30-year amortization. So your payment becomes a little bit less aggressive. Makes it a little more affordable. When it comes to qualifying, it makes it a little bit easier to get a higher price or whatever. That's the saving grace in a refinance, is that we can look at stretching it to a 30-year amortization if it was 25 years prior to.
Right.
But what all of it is that when you get your renewal offer and maybe it's overinflated and they're offering you 6.2% for a 5-year term, and we have the conversation of, I can get you 5.89, but let's talk about income. Let's talk about debts. Let's see what we're looking at.
Right.
If income has changed or if it hasn't gone up necessarily and you're now having to qualify at 5% higher than what you qualified originally, it actually could be a problem, especially if in a time of inflation and a potential recession and all of this stuff, has your debt racked up? Because if your debt's racked up and we can't get enough equity out of the house to pay it off, maybe equities come down, maybe the values come down, there's a problem. Or if you can't carry that debt while qualifying for your mortgage at a higher interest rate, that can be a problem too. And in a lot of situations so far this year, in 2023, people have had to just renew because we weren't able to do anything else for them. Still tried. It's still part of that phone call when you get your renewal offer. Let's see what we can do. But there's no guarantee because it's so a conventional rate. So let me back it up a little bit and talk about rates. So we've got a few different standards. I'm only going to talk about fixed because variable doesn't necessarily mean anything right now. If you are purchasing and you have less than 20% down,
Very common.
It's either called high ratio insured. No, that's it. High ratio and insured. There's a default insurance and premium that gets added. Guidelines are super strict, but you get the better rate. So those ones right now, if you are purchasing with less than 20% down, as of today, best rate that I found is 5.39% on a 5-year term.
Okay.
If you were looking at a 3-year term, which we'll talk about as being probably the better option.
Interesting.
Because we didn't really touch on prepayment penalties. A 3-year term is 6.69%.
Oh.
And so when I'm saying that it's not rate, I hate having to have a conversation about rate before we have a conversation about affordability and different options.
Yeah.
Right. So
even
6
though
points.
people want the rate right away.
Well, they do. Like, I mean, rate shoppers just want the best rate. They don't care about anything else. And it's fine until that's going to cost you money further down the road. And then you calculate to figure out which one is best and worst without having a crystal ball, without really knowing what's going to happen in the future, but being able to kind of predict and whatever else. So those are insured. And then if we're looking at conventional, so refinancing on a 5-year term. So so it's on a 5-year term, it's somewhere between 5.89% and 6.29%. 3 years, still that 6.69%. Those are bank, the sort of prime side of borrowing.
Gotcha.
Alternative is 7.04%.
Alternative
roughly.
Meaning?
So alternative lenders are if you have bruised credit.
Bruised, nice term. Okay, keep going.
Yeah. Well, B lenders, is that,
I don't know. Yeah, it's
alternative. It's slightly alternative because we've even got A-.
Yeah.
So again, without getting too far into the weeds on debt servicing and all of the calculations and thing that we have to look at, affordability comes down to the percentage of your monthly income that has to go towards your debt. And the more strict guidelines is a lower percentage. Better credit gets you a slightly higher percentage. But at the end of the day, the math is, this is how much money you have, this is how much debt you have, and do they all kind of fit within the parameters of what you can qualify for? If you don't fit within those prime bank calculations, as long as you have 20% down, you can look at alternative lenders to get a slightly higher calculation, a higher percentage rate of what you can qualify for.
Yeah.
And that's that, because of the stress test, you might need to get slightly higher rates or higher calculations just to be able to get a house that's available right now. Because at the end of the day, the mortgage that you get is probably going to be pretty reasonable by comparison to the same property that you would need to rent.
Yeah,
right?
Totally.
So all those alternative lenders, though, you still have to qualify at 2% above that 7.04%.
Right.
And 7.04% are for the people that have the better credit scores. So,
it gets even worse from there.
It does get worse from there. And it gets worse from there too. Like
for sure.
There's lots of options for people. Like, you don't just have to be able to qualify with a bank. And we're calling it worse. The rates are worse, but sometimes they're the only option.
Yeah, totally.
And sometimes they are the difference in saving you from not being able to have your house anymore. So
totally.
I love those worse rates because they have saved a lot of people. A lot of the time.
Yeah. No, I completely understand and feel that.
But going back to the rates and the prepayment penalty and the 3-year term and all of that stuff. Yeah. So these are part of the conversations that we have. I believe it's been proven, or it's a pretty strong stat, that most borrowers want to or need to refinance or choose to move within the first 3 years of home ownership.
Yeah.
So refinancing is, the 5 years has always been the most popular term to take. For first-time home buyers, in 5 years, you can have babies,
lots changes,
have weddings, change jobs, maybe rack up a little bit of debt because you wanted to do some updates on your home, whatever.
Lots happens.
Whole bunch of stuff. And so at the 3-year mark, it could be a great time to look at accessing some equity, if there's any equity in the home, to take a little money out so that you can pay off the wedding, cover the debt while somebody is on maternity or paternity leave. You sometimes will need a little bit of help to get over whatever's gone on. If you want to pay your mortgage out early, you don't get to just walk away for free. So it's a contract, right? Yeah. The bank is promising you, or the lender's promising you, a certain rate for 5 years. You're promising to stay with them for 5 years. And if you leave, you're promising to make sure to make it worth their while, essentially.
Yeah. They're anticipating that income from the mortgage. So,
Yeah. And it's the bank.
Yeah.
It's a business. They get their money.
Totally.
So when you have to have a conversation about a prepayment option, prepayment penalty, the standard calculation is the difference of, so the most money out of the two calculations, and it is either 3 months interest. And I'm talking about just fixed. When it's variable, it's just a 3 months interest penalty. Double check your commitment to make sure that there's not some hidden calculation in there.
Yeah.
But for a fixed payment, it is either 3 months interest or the loss of interest to the end of the term for the lender.
So that one always is like, what does that mean?
So we call it the interest rate differential.
Yeah.
And that means, so the bank right now is making 5.89% off of you interest per month. If rates go down to 4.5%, they have to reinvest that money with somebody else. They're losing money.
Yeah, a whole bunch.
They've made money, but they're losing money by having to reinvest at that lower interest rate.
Yeah.
And so they calculate how much money they're losing. If you have 2 years left on your mortgage, and it's 1.5% interest that they're losing per month, we calculate whatever that is based on the balance of your mortgage at the time of payout. And then you multiply it by however many months are left.
Lot of money.
So if it's 24 months left because you're paying it out at the 3 month term, I did these calculations for somebody the other day because we were talking about a 5 and a 3 year term. 5 years, this is your rate. Ride out the storm, see what happens, sit pretty, don't have to worry about anything. Or because you haven't gotten married yet, you haven't done the kids thing yet, maybe you don't want to, but maybe you want to go on a trip around the world, whatever. Yeah. If any of those things are coming up and in 3 years, as per the standard or the average, you want to look at refinancing or taking out some of the equity, and rates have dropped to 4.5% versus the 5.99% that you would get on a 5 year term, it's going to cost you $15,000 to break that mortgage.
It's a lot.
Or you take a 3 year term at 6.29%, pay $60, $70 extra biweekly. And at 3 years being the average, we get to find you another rate and maybe access equity without a penalty.
And the rates, fingers crossed, are lower then.
We're hoping. We're expecting. Like, I mean,
are we good? That's speculation.
Do not hold me to this.
Yeah, no, don't. This is me and you having a conversation.
I know, but
anybody listening, let me do the little disclaimer of some sort. This is not financial advice for you. This is two people just talking amongst each other, and we're just trying to figure stuff out.
There you go. We're chatting.
We don't have the crystal ball. If we say something that
and these are normal conversations that I would have with anybody that wants to chew the fat on what to do.
Yeah, for sure.
This is invaluable time, I think, that I am happy to spend with any of my clients to figure out what the best option is. But yeah, like we are in a spot where we are, in my opinion, is not, in most people's opinion, it's not sustainable. We are in the midst of an overcorrection. So the government overcorrects and then they overcorrect to bring it back. And I truly believe that the housing market, the economy tends to be a pretty big pendulum, and it has to just do these big swings back and forth, and somewhere in the middle is stability. And
that's a good way to put it.
I need this swing to stop and start coming back. Where that swing will be in 3 years, I don't know. But I am anticipating that rates will probably be hopefully in the fours, not necessarily low fours.
Yeah.
And we're talking those prime rates, like on the better credit, better beacons and income and all of that stuff. If they're in the fours and you're qualifying at 6.69% or 6.29% on a 5 year term, it's almost 2% penalty that the bank is losing and doing their math. And so it's not going to be the 3 month calculation. Because that's what it was for a while. Like 2 years ago, it'd be like, well, this is what it's going to cost to leave. It's either the loss of interest or it's 3 months. And odds are it's going to be 3 months because the bank will make more money by reinvesting with somebody else at a higher interest rate.
Yeah, and interest can go down much more anyway. So there was a small gap there.
I talked to somebody today who got 1.44%
Yeah, it's wild.
fixed. Oh, I said that already, but like it's crazy
wild.
to me.
It's wild.
And those conversations are, yeah, it's great talking to you. I'm glad things are going really well. No, we're not refinancing. Like, I mean, we can come up with a solution if you really needed to, but you do not want to break this mortgage.
Stick in that. And actually, something that I don't even have on this list that I've recently had come to my attention, which I find interesting. I'm not sure if you're familiar with this or not, but I didn't know this. That in the States, do you know States mortgage stuff at all? So I'll just touch on something and we don't have to go too much on it. But I didn't know this, that when they sign up for their mortgages, they do like the 25 or 30 year but they're fixed at that rate for that time.
Yeah.
Which is wild because I didn't even know something like that existed. I've never really
So
looked
we do
into
10 as our max.
Interesting.
And I mean, there's people that probably 3 or 4 years ago were like, I want to get a 10-year term, or let's think about it. And it sort of was like, it gets to that point where it's like, well, it's a little bit higher than the 5-year term. But I mean, again, well,
the crystal ball is so nice.
Oh, it would be wonderful. COVID, murder hornets, Canada on fire, right? Like
no doubt.
You name it. So aliens. But yeah, it's
that's wild though, that they will lock in for that long. Like they lock in.
Yeah, it's a big commitment. So I mean, I don't know about their penalty calculations and all of that stuff. I mean, I'd have to imagine it would probably be pretty hefty.
You would think.
Well, so here, even on the 10-year term, the prepayment, once you get past like the 3 or 5 year term, it actually gets a little bit softer. It's not quite as aggressive. It's also not very popular because that swing in the pendulum doesn't tend to, it's not as easy to sort of predict where you're going to be in 10 years. Your odds are you're going to have to break that mortgage unless you were like, this is my forever home. And I'm never going to take any equity out of it. And I'm never going to need to make any new life choices in the next 10 years. Fine.
Right.
But that doesn't happen very often.
Right.
What is it? Like you'll have 11 houses or something in your lifetime?
Something like that.
That's the average.
Something like that.
So
now I want to tell you a conversation I had with somebody because it's interesting where we're talking a little bit of speculating without trying to get people to do something based on that. But I was talking to my one buddy. He works at a credit union. And he's in corporate. And I like to chew his ear once in a while too to see what he's seeing. And it was interesting having a conversation with him because I was saying from my perspective, being a realtor, we're on the front line of what I call war, and we're seeing things as it's happening. The bullets are getting shot, and we're seeing day to day what's happening. And sometimes it takes not just one day of war, a few days of war, a week or whatever, to be like, this is kind of what's going on right now. Because you can't just be like, this is what happened today. This is the state of the market. Right. And I was saying that there's a lag time between that and the people we're working with, our buyers and sellers, because first of all, there's that little bit of time. And then when we tell them, they're still listening to what's happening on the news or their neighbor that recently did something or whatever. And even when we're telling them, it takes a couple months before what is happening now for them to understand what is happening now. And then there's obviously things are changing in that time.
Yep.
But then there's a lag between that and the media because the media gets a hold of things and it seems like what they're talking about is not new news either because they're not getting it direct. They're speculating on wherever their sources are versus talking to, I think realtors are a great source of information of what's going on because we're right in the streets with all different types of people.
Totally.
And then when I was talking to him about that, he was talking about inflation too. And he said that there's a lag with inflation. And he was saying that it's like sometimes 10 months difference between what is happening with inflation. And the way he kind of put it in perspective for me too, growing up on a farm, being a dumb farmer, is like, think about farmers that when they're going to plant their crops, they have input costs. So there's fertilizer, there's feed, there's spray, gas to do everything. But you don't see that until months later when the crops are grown and then they go to sell them and it's based on how much it costs them to grow everything. And then those things have to go to market. And there's huge months of gaps finding out between when things were expensive now versus once it hits way over there.
Right.
And I'm like, this is very interesting because he was talking about how like the government trying to correct inflation, however they're through raising rates.
Overcorrect.
Overcorrect. And that's part of like when you say that, it even makes more sense because like they raised rates how many times in such a short period of time? 10 times? I don't even know what the number is.
We're
I just
at 10,
know
I think, right now.
it felt like a punching bag getting hit over and over and over and over.
Yeah.
But you don't even see the results of that until whatever
a year and
it
a
is.
half, they say.
Okay, year and a half,
Yeah.
whatever it is. So the tail is swinging, and we don't even know exactly everything from what has already happened and the corrections.
Well, and that's, I mean, I guess there's a lot of, so there's a lot in what you were just talking about.
Yes.
We being collectively a whole of anybody that sort of has any finger or finger on the pulse of the economy, the housing market, anything finance related, there's a dark cloud that we're just sort of, carrying our umbrellas and hoping for the best, because we have not seen the worst of it yet.
No.
It's coming.
Yeah.
It's coming. So to touch on some of those aspects.
Yeah. What's the dark cloud? Holy.
So the news outlets, the news media frustrate me just a little bit, only because
A little bit. Wow. They frustrate me a lot, but okay.
Well, so let me tell you why I get frustrated. And again, my process, my brain works differently. Like, even when it comes to the borrower that can't quite qualify, or even somebody that's gotten a decline from a mortgage, which I like to try to make sure that I know that they're going to get approved before we start doing it. But sometimes the numbers just don't work. In any of those situations, I always have a solution before I tell them the bad news. Like, so this is where we are, but this is how we can fix it. And again, it's not necessarily a quick fix, but there's a fix if you're willing.
Which I always appreciate. Okay,
good.
continue.
Thank you.
Yeah.
So one of the things that the news does is it's really good at telling you about stats and ominously giving you a headline, clickbait or whatever.
Clickbait, totally.
And cautioning of where we're going. You can't really, I guess, over-focus to point out the people that are in those bad spots. You can talk about all of the bad spots and that there's people in them, but nowhere does it give you any true, strong solution on the fix, right? Like, hey, everybody, there is a problem.
Yeah.
Okay, now what? Like, how do we fix this?
Yeah.
Other than not spending, right? That's really we are trying to scare people into not spending by increasing this rate over and over and over and over again. That's our fix. But everybody's been called back to work, so you have to pay for gas, groceries. Like, you have to eat, you have to drive. Both of those things are like nearly mandatory to sustain life.
Yeah.
Those are the two most expensive things when they're talking about inflation. How do you fix that? How do you stop spending? It's not stop buying jogging pants to work from home in. It's stop buying groceries. Stop driving your car.
Yeah.
I mean, pay for an electric car. They're more expensive.
Yeah.
Retrofitting whatever to have the right plugins. It's a lot of money too. So those aren't solutions. They're, I mean, I'm not going to start a petition to go to the government to create some sort of budgeting format to help people in this situation. But
it'd be nice, but
the news puts stuff out there, and then the average Joe has to extrapolate from that, right?
Yeah.
Or know where to go to, or whatever. And generally speaking, it's human nature actually to be more paralyzed by fear than go hunting for a solution. So I don't find that the news is helpful.
It's not.
They're there to report, I guess, at the end of the day, but report some things that could be more positive.
I got to keep that thought, but I have to interrupt here because yesterday here at Right Choice, we spent almost an hour talking about what's going on in the news and stuff. And it's just like you said it, like what we try to provide solutions for people. That's not what they're doing.
No.
It's they just want more attention on their news, and they're driving through fear or whatever.
Right.
Whatever other motives they have.
But it's the most readily available information
Yeah.
when somebody wants to look into the housing market, because it's a hot topic always.
Yeah.
Right? Rates, what's going to happen next, all of that stuff.
Totally.
Nobody's talking about prepayment penalties, which they will, maybe.
Yeah.
But They are talking about all of the things that we live on a regular basis. They are for sure behind because also human nature. So one of the things that I find, I tend to get a slight spike in my busyness a couple weeks before people are actually going and buying houses in the market. And that's because those people that were pre-approved or paused the pre-approval because they wanted to wait for rates to come down or whatever.
Right.
As soon as they start seeing articles that rates are coming down, right? Rates have probably been coming down for a few days, and them and every other person that's been waiting for a rate to come down is now in the market ready to start buying. And then them and every other person that was waiting are now going after the same house that's been sitting there waiting.
Totally.
Right? For however long. So the lag is, there's a few things like, we start hearing bad news, paralyzed by not knowing what that means or what to do.
Yeah.
So we don't do anything.
Yeah.
Then we start hearing good news. So, okay, now's the time to do it. Well, no, now's not the time. Now's the time where it should be done because when nobody else was doing it was a really good time to start getting things moving.
That is such a good point.
Yeah.
And it's hard for people to grasp that. And actually, Kev was just here, and he thinks right now is a great time to buy.
It is.
He thinks so, and he wanted me to ask you that.
Oh, it is. So here's...
And it's I can't wait. I'm sorry to interrupt, but it's just so funny that we're going to be talking about that because right now, like you just said, there's so much hesitancy, and people are all like so much hesitancy in the market.
Yeah.
And that's the time to act not like the rest of the people.
Well, and that's probably key is, so you got to take the wins and the lose or the pros and cons with all of it.
Yeah.
So, Instagram Reels, Facebook, whatever.
Yeah.
What is it?
TikTok?
Marry the mortgage, date the rate, marry the mortgage. There's a very...
Date the rate, marry the mortgage.
Yeah. The mortgage is your long-term thing. Mm-hmm. The rate is temporary. Mm-hmm. Right?
Yeah. Never heard that one.
So part of that is why it's beneficial to buy now versus that, highly coveted low rate. Rates aren't going to be as low as they've been hopefully ever again.
Yeah.
If they come down a lot, it would make my life a lot easier, but it then creates that runaway train that the housing market sort of walked into.
Totally.
So by dating the rate, you get something short term, like that 3-year term that I was talking about. Mm-hmm. Because if you, what goes up must come down. That's the other one that people are talking about, right? When prices were going up, people weren't talking about rates in this instance, but when prices were going up, it was what goes up must come down. Mm-hmm. So the reverse of that is that what goes down must come up. Mm-hmm. And so the reason that prices came down was because rates went up.
Complete correlation.
Right?
Yeah.
Which is, suffice it to say,
yeah,
if rates come down,
prices
property values are going to go back up. So all of those people that were waiting for the bubble, other than getting a news article that says the bubble is here.
Yeah.
Right? Like, because I'm sure we're not going to get that headline. It's more in calculations. Housing has dropped 6% in however many days or weeks or whatever. Let's say the bubble's here. So why wouldn't you be buying now? Why wouldn't you buy before the rates drop? Because when the rate drops, you have equity that you didn't have when you bought. And it's not going to be as fast as it was, between 2020 and 2022. It shouldn't be. It was dangerous.
Yeah.
But you get something at 6.29%. Mm-hmm. And then in 3 years, you can get that same something, maybe smaller because you've taken advantage of prepayment options.
Be nice.
That same mortgage is still the same mortgage that you have at a lower rate, at a less aggressive monthly payment. But everything else, for anybody that doesn't know, when we talk about equity is the part of the house that you own, right? Mm-hmm. The mortgage is the part that the bank owns. Equity is the part that you own. So if your house jumps in value and you don't have a mortgage against that extra value, that is your equity.
It's amazing.
It's huge.
Yes.
You get a lower mortgage amount because you bought before everybody else was. Mm-hmm. You have a higher rate at that time that you made sure you could afford regardless of what the rate was. And then at the end, once we all come through that storm and maybe once that dark cloud finally goes away, you have more house, a better rate, and a smaller mortgage than you would have if you waited.
Doesn't that sound amazing?
This is my life. So yeah,
Yes.
this is, I mean, people are always going to need to buy. So there's also nothing wrong in waiting, because if you wait, you do
Right.
get that lower mortgage rate.
Right.
Fine. But if you're ready, like the best time to buy a house is when you're ready.
Totally. People ask me that, when's the best time for it? What time of year?
When you're ready.
Exactly.
And the best time to get ready, to be ready, is before you actually want to buy.
Yes.
So, I mean, that's, when I talk about marathon mortgages and stuff like that, if you're not ready today, but you have no idea what you have to do to get ready, then that's when you would have a conversation with a mortgage broker.
Yes.
Because the banks don't necessarily want to have that time
They don't
2 years in advance.
They don't want to put in that work.
No, I will. You're not necessarily going to be like, okay, I'm going to stop everything and we're going to book the call and get the paperwork and do it all. We're going to have a conversation first.
Yeah.
We're going to come up with a plan.
Yeah.
And then we're going to touch base every 4 to 6 months or something, just to sort of tweak it. And as long as you're doing your job with whatever it is that we need you to do to get to the point of being ready to buy, then I'm going to keep doing my job with you.
We'll get there.
Yeah.
Yeah. See, I want to touch on one thing too. That was all gold. But it's funny. Well, I shouldn't say it's funny because it's not funny. But talking to people and them, when I say, when are you going to be buying a place? And they're like, I'm waiting for the market to crash. Okay. But it's like, okay, fine and dandy. But then these same people, when it did crash, go down a lot, now say, you ready to buy a house? Rates are too high. Mm-hmm. So when is the solution going to be, right?
When you get out of your own way.
Yeah. But it's like, okay, some people don't realize that there's different variables here. So just because the price came down doesn't mean, so you have to figure it out so you can make it happen, because even if prices are down, it doesn't.
If something's come down, something else has gone up.
Exactly.
So, and I mean, you put it wherever you want. Like if there is a bubble, I feel like we're pretty close.
Well,
we've passed it.
And let me comment a little bit on that, because I'm sure but if people are listening to this and they've still made it this far, I've been in real estate 10 years. When I started 10 years ago, prices were flat. Just going up, like the national average was like 3% a year.
2-3%. Yep.
Yeah, it was so low. I remember some of the first houses I sold, people were losing money because they had to pay commission of 5 or 6%, and their house hadn't even appreciated. But anyway, to skip fast forward more, houses went up. They doubled a couple times over a short period before COVID, during COVID. And then when we hit the peak around February of 2022, we seen it come down. It's right around 30% from the peak.
Right.
And it's funny because when you say crash, like some people consider a crash like prices coming down like 100% or 90%. That's not going to happen.
No, hopefully people are not walking away from their houses. They shouldn't be. And there's enough safeguards in place that really, I mean, if anybody's seen The Big Short in 2008 and all of that stuff that happened in the States, I mean, we felt it here, but that's not going to happen. I mean, there will potentially be, there are going to be power sale. There are going to be bank sales. Like that is part of that dark cloud. Mm-hmm. That was happening even with rates really low though.
It always happens.
Right.
Yeah.
It's going to be higher. There are people in trouble. There are absolutely people in trouble. But I just had a thought and I lost it, but it goes back to, it is always a good time to buy. Yeah,
I know. And I wanted to just touch on like talking the crash or whatever, because we seen go down by 20%, 20 or 25, 30%. And then we seen a little bit of a recovery up 10 or 15. And now we're down like another 5 or 10. And like, obviously I'm talking about like a bar graph or whatever kind of graph, but we don't know where the future is yet. But like you're saying, it feels like, because we're somewhere around the bottom. Like, can it go down more from here? Sure, it can. It can. You don't think? Well, maybe, but
it
can't.
Like
it can't.
It just can't. We cannot withstand
So let me say where maybe myself a little bit concerned about where things could get from what my perspective. And this is one of the things I'm happy to hear from you, because I have no idea where it's going yet. But in the spring is when we're going to see where we see the most activity for purchases, right? Spring and summer. Like in the winter, we don't see a ton. So to me, in the spring, there's going to be a good test of what's going on with people that are renewing their mortgages, because those are the ones that are going to be that we're at the 2-ish mark. And then we're going to have the largest amount of people for the year renewing at that time. So I think the spring will be a good time to see how people renewing, how they're handling the changes.
So I don't
like this.
I don't believe that we're out of any woods, because I think that, again, like, so in the spring of 2024 is going to mean that it's about 3 years after not necessarily the absolute peak that we seem to see, but it's definitely going to be when people had super low rates and were maybe buying a little bit higher than what those properties are valued at right now. The average renewal or refinance at that 3-year mark, even, those people, I mean, there's some people that want to do it just because they want to. They want to renovate the kitchen. They want to pay off their car loans or student loans or whatever. They aren't going to have enough equity necessarily to do that. There might not be enough equity to get them out of trouble, because one of the things that people are going through right now is that, you know, all the savings that they managed to save up during COVID because you couldn't do anything are gone, potentially. Things cost more. You're putting more things on your credit card. And the savior of equity in your home is not going to be there. And so
that's scary.
It is. We are absolutely at a point of being able to be scared. Like it's not going to be easy to come out of. I think through all of that, again, pose a problem, have a solution. It's not necessarily a solution that's going to work for everybody, but you know, one of the things, and I think somewhere it's on your list of like, what do you want people to know, or first-time home buyers or whomever, and it really is ask for help before you really need it. Ask for help when you're thinking you might need help.
Good point. Very good point. Don't wait till it's too late.
Well, and you know, to go back to human nature is really to get scared and then to be paralyzed by that same fear.
Right.
And paralysis is probably one of the more dangerous things when it comes to any financial obstacle, is waiting too long, too late, thinking that you can solve it, thinking that you can come up with a solution for you and your family to get yourself out of whatever, you know, potential hole you think you're walking into.
Right.
And by the time you recognize that it is bigger than you and more than you can solve on your own, it's potentially too late. Mortgages, for the most part, have solutions built into them. Not necessarily built in like you're guaranteed to have a solution, but the banks, the lenders, they all know that people are in trouble or going to be in trouble. They know that it's a thing. Like even if it wasn't just a matter of inflation, people have life-changing things that happen, right? You get laid off and you're trying to manage on one income versus two. If you qualified for a house with two incomes and you lose one of those incomes, it is fair to say that house isn't necessarily going to be easily affordable.
Totally.
So, you know, one of the things that I've had this conversation recently too, and it's with a client that wasn't sure how they were doing and was kind of looking to see what options they had. And it was, call your lender. Let's figure out what they're willing to do. And if they stretch that amortization, right? Maybe you got it at 25 years. Maybe they're willing to go to 35 just to give you a little piece. They're not going to guarantee it. If you can't afford it because it looks like you bought a new car and bought a boat and went on a bunch of trips or whatever, they're probably going to be a little reluctant to offer help.
Yeah.
But if you lost an income, if you maybe lost a family member or had to cut back on hours because somebody at home needed more help, like things like that happen all the time. And if the solution is that everybody has to participate in making sure that you're not going to lose your house or have to file for bankruptcy or consumer proposal or whatever, those solutions are there if you don't ignore them.
Yeah.
right?
If you don't get in too deep.
Well, I mean, once you recognize that there's a problem, it's also, I mean, and this isn't even self-promotion. It doesn't have to be me.
Yeah. It's all good.
A mortgage broker in general, somebody that you've spoken to, maybe a financial advisor that you value as a person just to have an opinion. It's easier to talk to a third party just as a sounding board if they're willing to find time for you. And I like to believe that I'm not the only one that's willing to make that time.
There's less of you, but there are people available.
But we're out there.
Yeah, exactly.
But find one. And I mean, people make jokes where they're like, if I have questions, can I call you? You are stuck with me until you don't want me anymore.
Yeah.
That's kind of it. Like I'm not going anywhere. And if it's like, do I call, I'm not plugging their phone number, but like whatever, 905 something debt. No.
Right.
No, you don't.
Yeah.
You call me or you call somebody else first to say, I don't know what to do.
Yeah.
Right. And anyway, that's
come
kind
up
of
with some solutions, some options.
You got to make sure that you know if there are solutions first. That's kind of it. I did sort of remember one of the things that I wanted to touch on that you were just talking about, to go back to waiting for buyers now. One of the things that's going on right now is that because of rates and where they are, rates are super unappealing to investors, to flippers, and new regulations make it that you can't be like a true foreign buyer that's not living in the country and stuff. Those people are currently not really buying, right? Do you remember when the prices were going crazy and rates were super low and it was like, some investor came in and paid cash and firm deal and whatever.
Totally.
So for everybody that's waiting, you want to wait to be in competition with those people again.
Exactly. When the pool is huge.
Then keep going.
Yeah, exactly.
Right. So sorry, that was just to jump back.
It's totally true. And that just comes to when we talk to people about the different price points of houses, because people are, as we know, all different levels. But when houses at the bottom are most affordable, whatever that is. So that means it's most affordable for people that can't afford a lot, people that can afford more, investors, and like that's just a big pool of buyers. So it just makes it harder for those ones. Yeah.
It goes back to the waiting and stuff. But I mean, if all of these other people that are also not paying attention to what's going wrong are putting their house on the market for cheap, almost like in a fire sale, because they have to come up with a solution at that time, that also is something to not wait for, because those will also drive investors back. Yeah. Right?
Yeah, totally.
If power sale and waiting for a bank auction or whatever, that is a different ball game. So I guess back to Kevin's question, your point, it is not the time to wait. It never is the time to wait necessarily, because it's one of the hardest things to get into, the housing market. It
is very difficult at
is.
Any point.
Always. It's hard now. It's going to be hard. It's probably going to be harder later, because that's the other thing too, is that, watching how fickle affordability can be on any adjustment to the economy on any standard. Lenders recognize that. They have a team of what they would sort of call mitigation. It's worriers. They worry. They worry about their margins. They worry about profits. They worry about the cost of business. They worry. Yeah. They're now also worried about what happens next. What happens for these mortgages that are only 5% down, right? What happens that those houses don't have equity? What happens if there's another natural disaster of some sort that we have to try to figure our way through? What happens? And so what they do, the best way that people have, is to cover their butts or worry a little bit more about risk associated with any one of those loans that they'd be willing to put out. So all of a sudden, all of the things that have always been important are vital. All of the things that have mattered are everything. And, it's kind of, I had somebody trying to qualify for a rental, and they had a lot of rental properties, and he was like, it's never been this hard. It's like, right, but you're getting 7% interest, and most of your income comes from your rental properties. not sure, but tenants are pretty good at knowing most of the rules that look after them as far as renting. And I'm not saying that every tenant necessarily takes advantage of this, but they do band together and come up with ways to look out for themselves and not necessarily worry about what wreckage they're kind of leaving behind as the casualties of their decisions, which are generally the landlords.
Yeah.
Right.
Totally.
And so lenders look at that and say, like, can you carry this on your own? If your tenant leaves and it's vacant for a while, or if your tenant refuses to pay and you can't get them out of the house, can you afford this? And I mean, most people can't.
Right.
Like, most people do not have a contingency of being able to afford 2 mortgages, double property taxes, all the utilities and whatever.
You got to be making some bank to cover that.
While trying to fight to get the tenants to leave.
Right.
Right. So, I mean, I would love to say, like, don't do that. I know there are some landlords that don't look after their tenants and don't do the work and don't whatever. But being a landlord right now is really, really tough. And it's going to be really, really hard to qualify for rental properties in general. And I don't believe it's necessarily the greatest time to be buying investment properties.
Not yet. Why would you say that?
Just because the
rate's high.
So
it's good for people to buy now if they're buying for themselves, but not as an investment.
But that is my belief, is that is probably, it should be at least sort of the driving motivation behind everything that we're sort of living right now. If it's unappealing, so supply and demand, right? Like, let's go back to a year and a half ago when the biggest issue as far as prices jumping, 1 was low rates, 2, it was supply.
Inventory was super low.
Super low.
Yeah.
Is inventory better? Because it costs a lot more money now to build a house. So, like, even that's kind of slowed.
Yeah.
So if you kind of look through the catch-22 of all of it, where we need more houses, but even the builders have to pay more to get the materials to build the houses, which means then they need to have more buyers on board to be buying the houses that it costs more money to build, because they have to pay more interest to get the money to build in general.
Yeah.
But the values aren't as high as they used to be. And so maybe they're not getting enough money to build, to create the supply that we need to reduce the demand in the housing market. Where's the solution in that?
Well, this is part of what we talked about yesterday. I don't even know where you want to go with that yet, but I want to just chime in some stuff, because we were talking about this yesterday.
Yep.
Because I don't watch a ton of news because I don't love it, but when I do, and I do consume a little bit throughout the week, but I keep hearing the shortage of housing in Ontario or Canada. And what they're saying is we're bringing in around 1 million immigrants, or last year we brought in 1 million or 1.1, and we've only built like 200-ish thousand houses. So there's a shortage in housing. But from what I see, there isn't.
There isn't a
shortage.
In housing?
Yes.
Okay. Why do you say that?
Yeah, see, this is interesting because they say that in the news, but we have the most inventory on the market right now.
Okay, but it's also impossible. Well, I mean, people are either waiting or it's really hard to qualify, right? So to get to my point first, to finish that up.
Yeah, I love this.
So building houses are tricky, right? Through all of the stuff that I just said, that circle of affordability and money and whatever. With the rate increase, with the stress test, with prices not necessarily jumping to the same degree as they were before. You can go back to, and everything's on social media. Like, 10, 15 years ago, I guess, no, more than that, 15, 20 years ago, the news didn't travel to the same speed as it does now, right?
It's wild. Yeah.
So any monster like this would have been different in a different decade. Right now, people complain that it's impossible for a first-time home buyer. And so first-time home buyers absolutely agree that it's impossible for them to buy. Doesn't matter that same first-time home buyer hasn't saved, but has a really great, car or fantastic closet full of clothes and amazing eyelashes and a really bad Starbucks habit. I'm not going to talk to you about budgeting and where your down payment is being spent.
Right.
But For the first time home buyers that have done the work, saved the money, have the job and are potentially ready, they would miss out on a property, and the complaint would be some investor came in and scooped it up. Some flipper came in and took this, or somebody bought this house at $300,000 and put $50,000 worth of work and sold it for $500,000. I'm exaggerating a little bit, but not a lot for what was kind of going on in 2020 and 2021, right? So if you have all of those investors and all of those, flippers and maybe even people that were just figuring somewhere to park their money because money was super cheap in Canada, right? I'm not talking about, immigrants or new residents. I'm not talking about them because they're here, they're working, they're saving, they're doing whatever. I'm talking about people from another country that had no intention of moving here and are just buying a house because it's a cheap place to keep their money, right?
Yeah, yeah.
If those people are all gone, then theoretically, it's forcing there to be more houses on the market. And so you saying that there's more inventory than there's been in a long time proves my point, right?
For sure.
Because nobody's coming in and swooping it up.
Yeah.
Right?
Yeah.
You couldn't keep a house on a market for more than a day before.
Yeah, it was crazy. It was insanity.
Right. So now we can get extensions. We can have financing conditions. We can have time for an appraisal, home inspections. Home inspections.
Stuff.
People weren't doing home inspections.
No, insanity. On $600,000, $700,000, $800,000 houses without having a second set of eyes. Yeah.
So if inventory is there because the other people aren't, are they coming back when rates drop too?
They'll be back.
Right.
Yeah. Now's a good time.
Right.
Yeah, I totally agree.
I'm just making that point even more.
No, I totally agree. But to go back to that thing about the shortage, I find it funny because there's not a shortage, but there's not a shortage of housing.
Right.
I think that in the media, we were talking about it in the office because I'm like, when they say there's a shortage of affordable housing.
Yeah, that's different.
It's different, but when I hear that, I don't like to hear that statement myself.
Right.
Because I think it's the media playing tricks on people.
So let's find a new way to talk about it. So no, it's not necessarily an overall supply shortage right now. There
Definitely
was.
Not. Yeah,
there was, but it was because there was cheap money.
Yeah.
You had everybody buying
everything.
Like I don't know, can you do the math on how many properties any one individual owned? I'm sure it was probably like the average individual owns like 1.1 homes.
Yeah.
Well, not just one, more than one, right?
Yeah,
like the average of.
Exactly.
So if investors are getting rid of their houses because it doesn't make sense. And I mean, truth be told, buying a rental property right now at 6.5%, because interest rates are a little bit higher on a rental property. If you're having to refinance at 6.5%, or maybe you're on the alternative side and you're having to refinance at 7.5 plus 2%. If the tenants have been there forever and their rent's super low and the renewal rate that they're getting is super high and they're out of pocket. I know there are some people that have a big portfolio of rental properties that believe in functioning at a loss and whatever. Just the average homeowner that chose to keep their first home as a rental property and move on to the second home doesn't have the financial savings to be out of pocket when your rental isn't covering itself.
Yeah.
And when you can't get money out of it and you can't afford the payments and you can't maintain the cost of that home, you have to sell it. And just to go back to those tenants that aren't paying, when you have to sell it, but you have to sell it vacant and the tenants refuse to leave.
It's a long ride. It's a long, painful ride.
Well, and that's, just to show the other side of that is actually putting somebody in a really compromising position as well.
That too, for sure.
So there's a case that could be made for both sides.
Of course. Yeah. I think I want to ask you good advice for first-time home buyers. Even though we've kind of touched on it, I kind of want to package it into a spot here.
So good advice for first-time home buyers. full of advice. I would actually think that, I think I said it already, but get out of your own way is my best advice. And that is a big stroke of a brush just to cover a whole lot of things, because affordability is going to come into play. Your credit scores are going to come into play. And to break it down, you want to protect your credit score probably more than anything, because it does determine the rate you get. It determines the the qualifying percentage that you can get. I've seen credit scores be horrible because somebody was digging their heels in and refused to pay the last $20 on their cell phone bill, just because they were in a fight with.
They're proving a point. Yeah.
What point? What point are you proving other than you value the $20 more than getting a better interest rate? Right?
Yeah.
So that's one.
Pick your battle.
Yeah.
Yeah.
And that's get out of your own way.
Yeah.
Like digging your heels in to sort of fight them in or refuse whatever isn't going to get you a house. It's not even going to really get you anything.
Yeah, true that.
Other than a crappy credit score.
True that.
But having an established plan, I think getting ready before you even think that you need to be ready is a really good first step. Doing your taxes, learning how to maintain documents. And I mean, talk about a super unsexy thing to like getting a house, but I'm going to ask you for T4s and, oh my God.
Notice of assessments.
And know your login information and have a laptop and not just your phone. We can't use screenshots. Screenshots in dark mode, especially. Like I have to convert things into PDFs to send in to my underwriters. And when it's like this big, like black rectangle with some white writing in it that I have to convert into a full 8x10 document, it's like, no, I need you to get a laptop or even an iPad or like a tablet of some sort. I'm pretty sure that you just have to log into
your bank or CRA or both.
Have a CRA account for sure. Know your password, all of that stuff. Like it's all boring. Adulting is the key to easy mortgaging.
Right.
No, but on a bank, like a bank, online banking through an app has different information than a laptop, like through the desktop
browser
version or whatever, their URL.
Yeah.
But people don't remember their passwords. And so when I say I need you to do this, but could you do it from a computer? They send me screenshots and I say, no, I need a computer. And then they'll send me screenshots. And I finally had somebody that was like, here, can you please, here's my password. Can you figure it out? And I was like, yes. I went on. And I mean, as soon as I was done, I said, please change your password. I don't want this liability. But yeah, I went on and got what I needed on my computer because the screenshots weren't sufficient. And it's sort of like an inside joke of like, oh my God, I got a screenshot. So
you want to know something that I encourage everybody that starts here at Right Choice as a realtor, for them to get a password manager so that they have all their passwords.
Like a passkey thing.
And like to get secure passwords.
Yep.
And to have that because we have a lot of information on people that we need secure.
Yep.
So not only does it help secure it, but then you can log into everything
and know how to log. Yes. I mean, absolutely. My thing for first time home buyers is actually get a laptop because you can actually do a lot from your phone now that people don't have a laptop.
Right.
That sort of is the problem. But yeah, so document management, protecting your credit score, buy the house before you buy the car.
Oh yeah. That's a huge one.
Huge. And I mean, this sounds, like some sort of pretentious idea that I'm more important than people making their own life decisions. But if you're about to start a family and maybe your income's a little unconventional, talk to your broker to see what it means. Because I have somebody who he started a new job, self-employed or no guaranteed hours or something like that. And she was on maternity leave, but she went part-time and they didn't guarantee hours. and they want to refinance. They're in a house already, but they want to refinance. And it's like, well, we're a couple years away from it now. And he's like, it's like, should I have called you before having a baby? And it's like, no, but also,
Should I call
but
you
also
at 11
maybe.
o'clock at night?
Yeah.
Sherri, is this cool?
Sherri, so we're talking about starting a family. Is that okay? No, I'm not playing God. That's not at all what I mean. But it's also, if you don't know, if you're about to make some big life decisions, and one of those decisions is changing your financial system function, whatever, whether it's a car, babies are expensive.
Oh yeah.
Right? So if you're doing one of those things and you want to take a little of the romance out of it for a minute and treat them like financial decisions just to understand, having the conversation actually gives you an opportunity to not have any surprises. So, but buying the car second.
That's huge.
Is a big deal.
I think that's so huge. We have to say it again. Buy a house before buying a car.
Yeah.
Way easier to qualify for a car after you have a house than qualify for a house when you have a car.
Well, so especially depending on the car that you buy, right? And through all of that, it's also affordability, right? So we have to make sure that we understand that buying the car also could be the make or break for all of the other expenses, and choosing to buy a truck and all of the gas that goes into it and whatever isn't necessarily the best idea if you don't work in a field that requires you to have that sort of a vehicle. Yeah. But the other part of it, and we sort of talked about affordability and qualifying. Mm-hmm. Less than 20% down, which is the standard, more common for first-time home buyers. They normally do not have the full 20%. Yeah. You are, best case scenario, allowed to have 44% of your monthly income going towards your total debt. And by best case, I mean better credit score, provable income, all of that stuff. Like the AAA. I don't love calling them that, but like the strongest borrower. 44% of your monthly income can go towards your total debt. If, I don't know, 10% of that or 8% of that 44% is a vehicle, you are limiting yourself in what your mortgage can be.
Makes sense.
And I mean, just to go back to affordability and stuff like that, that 44% of your total debt is 44% of your gross debt. So we're not even talking about your net, like your take home income. Mm-hmm. So you really have to make sure that when you do choose to buy the truck, car, whatever, that it is still affordable. Yeah. And the best way to do that is to make sure that you have the bigger expense sorted out first and then see what kind of room you have.
Mm-hmm. So how much money does a first-time buyer need to buy a house? Can we put a figure on it? Or a range? In
Niagara?
Yeah.
Like I would say if aiming for a $500,000 home is probably a fair requirement. So you have to have a minimum of 5% down for any house from $500,000 or less is the purchase price. Once it gets over $500,000, they have a sliding scale for down payment requirement, which is then 10% for every dollar above $500,000. Yeah. Okay. So $500,000, nice, easy number. Yep. $25,000 down. That's a 5%. You also have to have additional money to save for closing costs, legal fees, land transfer tax, title insurance, all that stuff. Mm-hmm. It is a requirement because that's all calculated at the lawyer's office. Mm-hmm. It is a requirement that you show you have 1.5% of the purchase price in additional funds for closing costs.
So that would be another 75. Okay.
75, yeah. 72.50.
Whatever, yeah.
Just over $7,000, let's say. So and I mean, for first-time home buyers, it's not going to cost that much because they do get land transfer taxes, exemptions and that stuff. Still mandatory. You still have to have it saved. So you need $33,000 for a $500,000 purchase. Yeah.
That's basically the minimum amount of money a first-time buyer.
It's a great start. Like, I mean, right now, rates are a little bit high, but property values are low. You might be able to find something that you're happy with at $400,000 or $450,000, right?
Yeah,
not often.
We recently sold a house at $370,000. It blew my mind. Yeah. And it was a house that you could move into.
Yeah. Right. So 5% on that. If you're aiming for 500,000, but some gem happens to show up around the 400 mark, then awesome. Jump, take it.
Yeah.
Be ready first.
Yeah. So these are good points. So a first time buyer is going to need at least 33,000 kicking around.
I would say that it's fair. Yeah. Like
it's totally
you can't gauge for the lower price. Like you can plan for 500 and hope for 4.
Yeah.
But if you're only aiming for 4 and you find something at 450,000, you have to have the money for it.
Plan for the worst, expect the best. Yeah. Always. Yeah.
Yeah.
Yeah. Totally.
Yeah. So, I mean, paperwork, credit score, savings, a budget. Budgets are super easy.
How hard is it for first time buyers to save up that money?
Right now it's tough. I mean, it's tough in general.
It's possible though, right? Because this is the one thing that I'm not going to neglect how hard it is to get into the real estate market. It took me 35 years. It's not easy, but if you want to do it, save your freaking money.
Absolutely.
Right? Like you said, all those things, Starbucks.
So, and a budget, like a budget isn't necessarily something that's supposed to be limiting for forever. Budgets can be tweaked, right? So So anybody that hasn't done a budget before, you sit down and you figure out all the fixed costs that you have and monthly, Netflix, Disney, cell phone, Starbucks habits, but be honest, right? Like, are you doing takeout every single day of the week? And when you go and get your coffee, do you stop at a coffee? Do you get a fun coffee? Do you get a sandwich? Do you get egg
all
bites?
that up.
Whatever.
Yeah.
Starbucks is expensive for just, in our house, we call it a treat. And I bring my own coffee. I make it at home.
I don't even drink coffee.
There you go. So for me, I know that I don't have willpower.
Yeah.
I know that if I go into a gas station, I probably come out with a bag of nuts.
No doubt.
Like I don't need cashews. Like it's not even like I'm doing like the cheapest nut I can find. I find like a macadamia nut or a cashew or whatever.
No doubt.
So I pay at the tank.
Yeah. Smart.
Because I know I don't have the willpower.
That's great.
I don't have the willpower to not get a pastry of some sort when I go through a drive-through. So unless somebody else is getting me a coffee and I can, sort of piggyback on their willpower, I just bring it from home.
Smart.
Every once in a while I go through and I get a sandwich and a pastry. But I don't do it every day because I know that financially doesn't make any sense when I can make a cup of coffee far cheaper at home.
Fractions of a dollar versus $8.
Yeah.
Yeah.
Now, go for a treat, have dinner out, but you don't have to do dinner out every night. You don't have to take advantage of all of the things like that we have, like skip the dishes and DoorDash or drive-throughs.
Yeah.
If you, sort of gauge, if there's 7 days in the week and you want one treat a week, fine. Decide that. Choose that. You don't have to go out every night on the weekend. You can do something at home, like whatever. So by doing a budget, you can see how much it actually costs, like what the fixed costs are. You work in travel, gifts, all of that stuff. Usually annually, you figure out what that would be sort of biweekly or monthly. And in that, you can also build in the goal. If you want to save $5,000 a year to go towards your down payment from being 20 until whenever, truly, it's only until you're 26 or 27 years old to have that $500,000 down payment requirement, right? $5,000 a year can be figured out to sort of be like, okay, well, that's only, a few $100s a month.
Manageable.
It's manageable. And if that means maybe not having Apple TV or maybe not having Disney Plus for a couple years, but your friend has Disney Plus so you can go over and watch whatever you want to watch there on whatever night, then you take advantage of things like that.
Is that called being responsible?
It's everything that I talk about is all about responsibility when I'm in mortgage mode.
Yeah, no doubt.
Actually, even when I'm not,
carries over.
Well, I'm pretty boring when it comes to we don't do lottery tickets a lot in my house. Alex loves lottery tickets. I don't fully agree with it. I pay a $1 a week for an office pool that I participate in.
Yeah.
That's my lottery.
I feel you.
Yeah. So there's money there if you're being responsible with how you're spending it.
Yes.
But also, for the 5% down, one of the things that, and I don't know how many people necessarily know it in Niagara, we do have the housing grant.
Yes. I'm glad you bring this up before I did.
Yeah. As a segue.
Yes.
So it's got parameters. It's got sort of a fact sheet of who fits and who doesn't. At the end of the day, it's not a giant purchase price that you can qualify for, but
this
Niagara
is the
region,
welcome home grant.
Welcome home grant. The Niagara region has a 5% grant that they offer right now. I mean, they could change their mind at any point in time. They do tend to change the parameters a little bit with affordability and stuff as well. As long as you are a Niagara resident and you have been for no less than 6 months, you are eligible for a 5% forgivable loan that can go towards the down payment on a purchase. Forgivable as long as you stay in the house for 20 years and it's an owner-occupied property. But if you are going to sell it or refinance or whatever, you only have to just pay it back plus the 5% in the property appreciation. Which if you're...
Let me clarify how that works. So if somebody, let's put some numbers to it, used the welcome home grant to buy a $300,000 house, they would have been given, if they qualified and all that, the 5% to buy
$15,000 down.
$15,000 down. So if they stay there for 20 years, they keep that money. That's number one. But now if they decide to move or refinance after 10 years.
Okay.
So
what's the house worth?
Let's call it 400,000.
Okay.
Let's say it went up $100,000. Is that a bad number to pick?
Well, no, I've got to do, normally I have time to sit there and do the math and calculate it because it's the 300,000.
Yeah.
Right.
If there's an easier number, by all means.
No.
Just pick something.
So we would calculate what the current value is of the property.
Yeah.
Less the original mortgage that they took and the down payment, because that obviously has to be paid back. So yeah, if it's 100,000, it is 5,000. So 5% of the appreciation goes to them and the rest of it's yours.
Okay.
Like it's not, sorry, I just had to get my head around it before I was talking numbers. It's not a lot if you, so only going up, or I guess going up 100,000 in 10 years, I guess that's probably feasible. Maybe not at that purchase price necessarily.
Yeah.
But I had somebody who, got the grant and then it was getting really limiting for her to keep the loan in place without being able to refinance to get a little bit of help for paying off debt or paying off a car loan or student loan or whatever. And we did the math, and I think that she was near that 10-year mark as being in it. And the amount of money that she had to pay out was insignificant for what we could get to then help her out. And her payments were probably still pretty much the same. So it really wasn't that big of a deal. But it was awesome. It was an awesome opportunity for her. So to go back, so as far as the forgivable loan, it gets you into the house.
Yeah, totally. And I didn't quite realize that they do take basically the 5% ownership.
So they take their money back and then they take back their appreciation.
Yeah.
But the goal could also be like, how quickly can we get away from it?
Totally.
Because once they get that money back, that's also maybe an opportunity for somebody else to have the housing grant, right?
Yeah.
So this is to get you into a house, and then you make the decisions to make responsible choices and then refinance shortly to pay them off.
So what are some of the qualifying factors? I know that it changes in this, that, or the other, but just some rough.
So they have a limitation on the purchase price. So the house, I think right now is about $425,000 as far as the limit.
Take. Yeah.
They have a maximum amount of income, and it has to be combined income for everybody in the house. So even if it was like a single income plus childcare benefit or something like that, that's all income. So we have to include it all. I believe the limit is about 84,000 and change, 85,000, something like that total. You have to fit within the insurer's guidelines. So that less than 20% down, strict calculations, all of that stuff, you have to fit there. So you have to protect your credit score, keep a steady management on your debt and debt repayment and stuff, provable income, I'm trying to think of what else.
That's the basis. Anyway.
Yeah, I mean, that's the basis of any mortgage. This is really just as long as you've structured your position to be a first-time home buyer with 5% down, you're pretty much going to fit within their qualification requirements anyway. Mm-hmm. So that's the crux of it, I think. And assets. You can't have more than $30,000 in your own personal assets, but you can also have additional money for the down payment.
Interesting.
Up to that $30,000. But if you had a family member that wanted to gift you money, or you had some RSPs that you wanted to withdraw and use as your first time home buyer option, you can. And that money would all go towards the down payment, which already kind of puts you in a position of being in a better spot anyway and makes your monthly payment a little bit more manageable. But yeah, it's still fitting within the regular qualifications. We do the legwork in advance. We do the pre-approval in advance. You have to get a letter from the housing grant company or housing grant, Niagara Housing, to let you know that they've allocated X amount of dollars for you. And then you buy a house.
So just a summary of that. It's a purchase price up to $425,000, which is still ish possible now, give or take. Mm-hmm. Household income of about up to $84,000.
84 something,
give or take. You got to have good credit, and then
a job.
Job. Other things apply. Rock and roll. So that's available for residents of Niagara. You said then living here at least 6 months.
At least 6 months.
Yeah.
And the caveats to all of that is that this is a situation where like a cosigner doesn't necessarily work. By adding a cosigner, you're adding income and you're increasing all of the things, and then you don't qualify. So really, you got to be able to do it yourself. Make it happen. But it's a great opportunity for people that have maybe managed to save some money, but have debt that's kind of limiting that 44% calculation. Use some of that money to pay off your debt. I mean, they probably wouldn't necessarily love me saying that, but get yourself into a better spot, and then you can get the help to get the house. Yeah, totally. Because you can't necessarily get the house and try to pay down your debt after the fact. Houses are expensive. And if it's hard to save, it's going to be hard to pay down debt once you're in a house. Yeah. That's a nice little thing that the region has. I don't know. Do you know it's amazing.
If other areas do stuff like that?
Hamilton has one, I believe. I don't quite know the particulars about it.
Interesting.
And I'm sure there's a few.
And I didn't even know if we wanted to touch on the first time buyer stuff that the government came out with. So it works pretty similarly to that one. But a little bit different. But they're limiting too. The first time home buyer incentive program. So there's a few things. First time home buyer incentive program, my personal opinion is I'm not a big fan. Yeah. It came out in an election year when everybody was complaining that, the first time home buyers needed help. And so they were like, here. And it doesn't help. Yeah. It will, the help is that it helps to reduce your monthly payment by a couple $100 usually. Mm-hmm. You have to have 5%. They match the 5%. You have to pay them back 5% plus 5% equity. So it's similar. Yeah. But you have to have money already. It's not forgivable like the region. No, you have to pay them back. Have to. I haven't looked at it in a long time. I know, because I don't like it either, so I don't know all the details either. Because when I looked at it, I'm like, this is trash. But it reduced the borrowing power based on their rules. Right. And it was for people that had $120,000 income, I think was sort of where the limit went. So a little bit better. Mm-hmm. But yeah, it was limiting in general, and it really only had more than anything an offset of the monthly cost, which is helpful for affordability, but not helpful for getting you into the house. Mm-hmm. So that's the first time home buyer incentive program. There is the new home buyer savings account, the tax-free savings account, where you can put $8,000 up to $8,000 per year for 5 years to have $40,000 saved. Mm-hmm. It's awesome. It's a savings account, but it's, human nature. It gives it a title for being a home program, hopefully to get people to take advantage of it. Right. There are, ways that if you don't end up using it, it can flip into another investment and all of that stuff, which is awesome. Yeah. But if there's anything to take advantage of, it's all savings. You still got to do the work. Yeah, true that. You got to do the work. True that. You just have to want to do the work, and that's going to be the difference. They are not giving out houses. Yeah, true that. They never were. They were giving away money for pretty cheap, but they're never giving away a house. True that. So, still got to do the work. I think the last thing maybe talk on that you just told me about that I didn't know about was like the relief that some organizations
Lenders have and stuff.
for
Oh, the
people,
hope. Yeah. So,
which I didn't even know about. I did not
well,
know
and
that existed.
they don't broadcast it. I mean, they definitely participated during COVID when people were deferring their mortgage payments and stuff.
Right.
That was kind of when they started showing their hands, or maybe got their spotlight for the first time
Right.
ever. Because normally it's just to back up, default insurance, anything less than 20% down automatically has a default insurance premium that gets added to the mortgage. That's CMHC, which anybody that reads articles has probably seen the abbreviation. There's Sagen and Canada Guarantee. They're all insurance companies. They all have fairly similar guidelines that they hand down to the lenders to sort of interpret and put together their products for qualifying. All through those insurance companies, they are there to provide incentive to the lender to fund mortgages with only 5% down, because there's coverage. In case there's default, there's coverage to sort of look after the lender to make sure that they're not out of pocket if somebody wasn't able to maintain their mortgage and they had to sell the house quickly to get their money back. Lenders don't want houses. They want money, right?
Yeah, totally.
So how do we get our money back fast? Default insurers are there to sort of say, like, okay, we will make sure that you guys are protected to a point. They don't make sure that you're covered 100%, but they're there to provide some coverage so that the lender, the bank, isn't out of pocket if somebody's not able to maintain their payments. In those same programs, there is some small coverage for the borrower. I mean, mostly it's for the lender, but
which
for
I
the
didn't
borrower.
know about. Yeah.
And it's so the one that we spoke about the other day was the HOPE, and that's the Homeowners Assistance Program through Sagen. That's one of the three. If you are in financial trouble, if you are in a variable rate and your payments have gotten pretty high, if inflation has, beaten you up a little bit and you need some help, you can actually call them and initiate a case, and they will start to help you communicate with your mortgage provider, with your bank or your lender, to see if there's a solution. And sometimes it's just relief of like a month or two. Like, okay, we will pause or defer your mortgage payment for a couple of months to give you some breathing room. In other situations, they can extend the amortization. And so that's less than 20% down. It has to be a 25-year amortization to qualify. They can stretch it to maybe 30 or 35 years to give you some relief. It doesn't necessarily make any of the money go away. You're probably going to end up paying, more interest down the road, but you're going to get relief for affordability.
Weather the storm.
That's it, right?
Yeah.
Like right now, it's really like how big of a Band-Aid do we need to fix whatever problem you're in, so that you can get to the other side without more damage.
Makes
But
sense.
it's huge. And that goes back to the, if you're in trouble, if you're feeling that something's going on, now is the time to pay attention to it, not when it's really bad.
So if somebody wanted to look into that, do they call their bank? Do they call their mortgage broker? Do they call the...
Any one of those people should be able to help. Everything is in your commitment. So we're really big on disclosures. So everything that you need to know should be in your mortgage commitment that you got when you first got your mortgage. Does everybody know where those documents are at this point? No. If you don't, you call your broker. If you're not sure, you call your lender.
Yeah.
Just the customer service phone number that you can either find online, or if it's a bank, you can call the branch or whatever. If you have a broker, you can call them because they will have it as well. And you look up the company, but I can look up the company. If I'm not even sure, if it didn't happen to be in that one, you can call all three of them and say, do you have my insurance policy?
Yeah.
Not the fastest way to go about it, but you can still call.
Yeah.
They'll want your address, they'll want your name, and they'll look it up. And if it's there, they'll say yes. And you tell them what's going on and they look into it for you.
Yeah.
Or tell you where to go to look into it.
Yeah. Yeah. It's nice knowing that is available for the people, because there will be some people that will need that might not know that's available.
Yeah.
And if people are waiting too long, Yeah.
That's always the worst part of it.
That's why I'm hoping if anybody made it this far, and if they are feeling a little bit of a pinch, that there might be some hope. That hope might be there.
Hope is there.
It's a good term that they came up with.
Yeah.
So it's nice to know that that's available.
Yeah.
One thing too, where we talked about, do you think it'll ever change where that sliding scale of a down payment over 500 with the prices going up will need to change from that 10% or whatever? Do you think that'll stay? Because that's like, I'm sure that's all built in on helping reduce risk of all these things and getting more skin in the game.
So
Because
do I think that that's going to be a change? I mean, I would have to sort of think about the long game in what the
what do you think some
implications
changes might be with some stuff?
The changes that I would love would be, maybe adjusting the stress test. You know, like the reason that people are really concerned about the Bank of Canada increases and all of that stuff is because we are getting to an unsustainable point, which means why are we stress testing a rate at 2% over the current rate if that would be
it's almost
like
time
mass
to take that
devastation,
off.
let's call it, right? Like if it's going to have that horrible of an effect, why would that be our gauge? So I would love for there to be a change to the stress test. Mm-hmm. I would love.
Do you think that could happen? And I don't want to ruin your thought, but
I think it should happen. I'm sure that there are people talking about it. Do I think that it's actually going to be a thing that happens? Unfortunately, I actually think that it's got a little too much clout for some of the saving that it did because of where we are right now, right? Like anybody that bought at the height of COVID, I mean, other than values and properties being down, they still got stressed at 2% above whatever the contract rate was that they got at that time. And so those people at renewal, maybe they can't refinance to get a better rate or take money out of it, but they can at least afford what the rate is that they're going to get because that stress test was there. Yeah. So my concern is that because that stress test got some clout and some weight, maybe we're at that point where they're going to be like, no, it's got to stay. I would love for an amortization to get stretched from 25 to maybe 30 years for first-time home buyers to help get them in the market.
So that's not available right now.
If you have less than 20% down, you cannot get anything higher than a 25-year amortization.
And if you do, you can go as far as 30? Can you go
30 on the A side? Alternative sides will sometimes go to 35. And there's some, they don't really do 40 anymore unless it's like a have to, but they charge you through the nose for it.
Right.
Like a super high
rate. So
rate.
you'd like to see it get extended a little bit.
I would love a 30 year. They used to do it. You used to get 40 years on an insured purchase.
Yeah. Any other changes?
That's how I bought my house was 40 year amortization. I only pretty much paid interest the whole time for the first 5 years, but I had a house.
Yeah, totally.
Yeah.
Totally. Any other things? Those are the two big ones.
Those are pretty huge. I think those by themselves would probably be
big improvements. And see, like I've never really thought about stretching out the amortization, but when you say the stress test, to me, the stress test came in when interest was so low, and it was like preparing everybody that interest is going up. That's how I seen it.
Yeah.
When I heard the stress test, I'm like, okay, they're starting to prep.
Yeah.
Interest is going to go up. So now that it's gone up, and unless they're planning on it going up more, so I don't know, but maybe they haven't decided yet.
I really don't think that it's sustainable. Like we are, and I'm
right
hoping
now the way it is.
I am hoping we are almost at the end of that massive swing of overcorrection, and then they're gonna. I mean, the minute they start saying that we are in a recession, I feel like maybe that's when some of the correction starts to happen. When they see the devastation that some of this is going to be causing, which again, back to your friend from Meridian and stuff, or Credit Union, sorry.
Yeah.
We're there. Like we're gonna start seeing it. It's popping up here and there. We're going to see it more and more. And that is a sign of where we are. And
so do you think if interest rates come down then would you say to keep the stress test on or?
Oh, that's a good question.
Yeah,
so I guess you can't really get rid of it if you're,
Yeah. See,
you got to think of the long game.
yeah,
Like what happens
I know.
if?
But that's a good point that you bring up. And yeah, because like I wasn't myself, I'm not in your shoes. So I wasn't thinking about the stress test having the negative impacts now. I just think about bringing down the interest so that we can get back.
Because it is better, right? Yeah, we just want to sell houses.
But then, if you do bring it down, then maybe having the stress test still in there, or I don't know if modifying it, I don't know.
Well, so it doesn't need to be as aggressive as it is. It doesn't need to be that somebody on the alternative side is having to qualify at 10%. Like if you get those higher amortizations or have crappier credit, you get a higher interest rate. If you're getting 8.5%, qualifying at 10.5%, how are you getting anything?
Yeah, exactly.
And those are people that are being kicked while they're down for the most part. Because they're, whether it's their fault or not, they're in a situation where affordability is tough and then you're making it harder. Right? So, I mean.
Yeah, so they might be even... Yeah, you're saying like get rid of it if we're going to hold here because that's where we are.
Well,
anyway.
You said get rid of it. I said I feel like it's got too much clout because it has saved people. Yeah. So, I mean, even by pointing out the long game, I really don't think that they will get rid of it completely. Yeah. There's going to be policy changes, hopefully, that will find a way to make it easier for people that have done the work. Save the money. Pay your debt, make responsible decisions, have a house.
Great advice.
Right? Like that's it.
That's great advice. Remember when you're like, is this going to be 2 hours? And
I know. I'm watching you write down the time and I'm like, I'm talking too much. But
no, it's not. I love it all. Is there anything you want to talk about before we shut her down?
Well, I think it's funny. You keep saying if you've made it this far.
Yes.
And you're not sure where to start or what to do or what it looks like. Mm-hmm. Again, it doesn't have to be me. I mean, I'd love for it to be me, but it doesn't have to be me. Have a conversation with a mortgage broker. And I mean, sometimes it's like, okay, is this the job that you're going to be at for a handful of years? Is this what you're aiming for? And, most people in that field don't have guaranteed hours. So it's going to be a 2-year time lapse of whatever to get there. Having a conversation, pre-approvals are free. Conversations are free. And I, within reason, I don't, set time up for a whole week to be free advice that takes away from looking after my clients that are sort of on the go. However, I am absolutely happy to block off some time to have the phone call. And I really do. It starts with an application or answering any questions that maybe this has caused or just reading articles has caused and you're just not sure about anything. We'll chat. And if I can't talk for long, then we'll chat on another day and we'll just keep it going.
And sometimes when I tell people, talk to a mortgage broker, they tell me I'm not ready yet.
Yeah.
And I'm like,
best time.
I'm like, that means you're ready.
Totally.
I'm like, now.
Oh yeah. There are people that laugh at me. Like I love a plan.
Yeah.
I love a plan. I plan my spontaneity. Right? Like that's just sort of how I work. My brain works. Mm-hmm. Understanding where you are, understanding where you want to be. There's a big gap sometimes in between those two. And if you're just sort of wandering aimlessly, how is that beneficial?
Yeah, totally.
Just focus it a little bit faster.
Totally.
Yeah. So that's it. That if anybody wants to have a chat, get a coffee.
And if somebody wants to chat with you, how do they find you?
So www.sherrivigna.ca.
Yes, that's got all your contact info.
Well, yeah. Are you going to put my name up somewhere on the post?
I don't know.
I'm easily searchable.
Yes.
There's links to book a call. You can send me an email. You can start an application. If you start an application on my website, it notifies me and you generally will get a phone call within about a day. Depending on when you do it.
Yeah.
But all of those things you can do while you're watching TV at night. And by the next day, I'm going to get that notification and reach out. Go
to your website, sherrivigna.ca, you said.
Instagram, my link's there too. All of it. You can Google my name and all of it will come up if you don't.
Sherri Vigna Centum. That's an easy guarantee to find you.
Yep. Yeah. Sherri Mortgage Broker, Niagara Centum, like all of those things should find me too. Yeah. Sherri with an I.
Yes. Yes.
I don't know if misspelling shows up, but yeah.
Yeah. Last thing that I tend to talk to people about food. We did not talk about food almost any at all, but just for funsies.
Okay.
If you were on death row, what would your meal be?
Oh, man. So it's funny. In my house, I make a lot of jokes about our limited food choices. Alex has gout or suffers from gout, so we have to be super careful. So he does chicken. It's a lot of chicken in our house.
Yeah.
And when we first started dating, he said, "Oh, do you eat meat?" And I was like, "Oh my God, all of it. Love it all." And I was like, "Oh my God, do you not?" And his response to me was, "I'm the son of a butcher." And to me,
right,
that means like we're going to have all of the meat.
Right.
The steak, the venison, whatever,
right.
Like maybe some rabbit at some point in time. Like I was like,
love rabbit.
Okay, awesome. And then I find out that I'm going to spend the rest of my life eating chicken.
Chicken all the time.
All the time.
So chicken's not on your
Chicken's off
death row.
if like death row. So it probably would be a steak.
Nice.
Or a lobster.
Well, listen, it's death row. You pick. You can have all the things.
I would probably have it all. Like I would probably have every meat that's not allowed in our house for
That's
death
hilarious.
row. We go out for dinner and I'm like, where's the seafood? Where's the steak? And which one am I getting? And Alex will default and look for chicken and pasta. So
how do you like your steak cooked?
Medium rare.
Same. Nice. So
Covered in salt and pepper.
So you'd have a whole bunch of meats and seafoods.
Yep.
And you like lobster? You like shrimp?
Yep.
Scallops?
The only thing that I'm not a fan of is okra.
I don't know if I've had that one.
It's like it's a vegetable.
Oh.
It's like a cucumber / pepper, but it's the size of a mini corn. It just has weird texture once it's been cooked. It's the only thing I don't like. Okra.
What about oysters?
Oh, oysters. Yeah, I'm okay with oysters.
Sushi?
Yep. Love.
Okay, so you'd have a whole bunch of meats. What about, would you have anything to wash it down? What would be there for drinking?
Oh, maybe like a red wine.
And a dessert?
Nope.
No dessert.
I just take extra meat. That's like, I'm a savory girl. So I would do 2 entrees or an entree and an appetizer over dessert.
No pizza in there.
I'm not opposed to pizza ever. I don't think I've ever met a pizza I didn't like.
I like it.
Yeah.
I like it.
Yep.
This was good, no?
That was good.
Look at that.
I know.
2 hours.
Yep. Thank you for anybody that's still listening. It's awesome.
We did it.
We did.